Kia ora, and welcome to Monday's Economy Watch, where we follow the economic events and trends that affect Aotearoa. I'm David Chaston, and this is the international edition from interest.co.nz. And today we lead with news. The rise in long-term benchmark rates is echoing everywhere, including in New Zealand. But first, if you're just back from your summer break, welcome back to work. Those benchmark interest rates have been on the move up while you've been away. The week ahead will be focused locally on early indications of the fourth quarter 2024 inflation. We get the selected price indicators for December this week on Thursday, to be followed by the full fourth quarter CPI next week on Wednesday. In Australia, their December labour market report is also due out this Thursday. In the US, the main focus will be on earnings reports from big banks. And the US will be releasing their CPI data, and given their rising inflation fears and rising interest rates, that could well be a significant market mover. Currently, markets expect it to run at 2.8%. Up from 2.7% in November. But you have to say there are upside risks here, and financial markets are pricing those in now. They will release their influential inflation expectations survey on Wednesday, New Zealand time. China is set to release a suite of economic indicators this coming week, including fourth quarter GDP growth figures, as well as data on exports, imports, industrial production, and retail sales. Later today, we expect their new yuan loan data for December, anticipating it to be weak again. But first, over the weekend, the US economy added 250,000 jobs in December, and much more than the 212,000 in November, and way more than the market expectations of 160,000. Their jobless rate fell. These are the headline rises. The actual change was a tiny fall to 160.5 million employed workers, but actually a much less reduction than seasonal factors would have indicated. For all of 2024, they had a rise of 2.2 million payroll jobs, and for the 4 years of the Biden presidency, a rise of 16.9 million new jobs. In the 4 prior years, there was a loss of 2.6 million jobs. The wider employed labour force only grew by 11.7 million in the past 4 years, as many people transitioned from unincorporated self-employment back onto company payrolls. In the 4 prior years, the wider employment labour force shrank by 2.2 million people. Any way you cut it, the past 4 years have been a golden period for American employment. And average weekly earnings rose 3.5% in 2024, up 20% over the past 4 years. For the prior 4 years, they rose 18%. But Americans are increasingly fearful of the year ahead. The latest University of Michigan Consumer Sentiment Survey in January dropped because of surging worries over the future path of inflation. Year-ahead inflation expectations jumped to 3.3%, the highest in 8 months, from 2.8% in December. This is only the third time in the past 4 years that long-run inflation expectations have shown such a large one-month rise. Consumers know they'll be paying much more if tariffs are jerked higher soon. And financial markets also reacted to the jobs data and the impending impact of tariffs. Wall Street equities were 1.5% lower on Friday. Bond yields have jumped, and a risk-off defensive tone spread, which saw the US dollar rise. And that's all because of the strong jobs data that argues for a Fed rate cut pause. Their bar for rate cuts has risen noticeably with this data. The Fed next meets on January the 30th, New Zealand time. Prior to this jobs data release, the Atlantic Fed fourth quarter 2024 growth estimate was 2.7%. The subsequent long-term labour market data may see an upside to that. Canada also reported their December labour force data over the weekend, and that was strong too. Employment there rose 91,000, with more than half of that as full-time jobs. Their jobs growth was far higher than the 25,000 expected and the 50,700 in November. This surge also calls into question whether the Bank of Canada will actually cut rates when they next meet, also on January the 30th. The latest Japanese household spending survey indicated another fall in November, part of a pattern of monthly falls since early 2023. But this one was a little different because it was the smallest surveyed fall in the series and a much improved result than from the prior months and from what was expected. Some see a turning point there. In China, in a surprise move, their central bank said it would suspend Treasury bond purchases in the open market due to a supply shortage, effective immediately. They'll resume purchases at an appropriate time based on market conditions, they said. The move comes amid repeated warnings from them about bubble risks in their overheated bond market, where long-term yields have plummeted to record lows. Over the past year, yields on key bonds, including the benchmark 10-year government bond, have reached unprecedented lows as investors flock to safe haven assets. This shift is largely driven by the ongoing economic uncertainties linked to the prolonged property market slump. In December, Chinese leaders signalled further rate cuts, fueling another surge in bond market activity. This pushed the 10-year Treasury bond yield to an all-time low of 1.6% earlier this month, exacerbating concerns over market exuberance. Their yields recovered after the move, but the recovery didn't hold. But at least they arrested the decline, and the day ended unchanged. Chinese analysts are expecting bad news coming from a series of large zombie property developers that have been holding on with government funding support. But most of them seem to have reached the end of the line, and a series of default into administration events are now anticipated. Investors will take a bath. None of this will help the economic mood there. In India, their industrial production showed a small improvement in November, up 5.2% from a year ago, with manufacturing up 5.8%. Both results were better than October and better than expected. In Australia, their federal government accounts for the 5 months to November show that tax receipts are surging there. That is cutting into their budget deficit for the year quickly. At the current rate, the full-year budget deficit may halve. If the trend continues, they may even have a chance of posting a surplus. The reason for the improved outlook is twofold. Their jobs market is buoyant, generating higher income tax deductions than expected, and their currency is falling versus the US dollar. And as their mineral exports are sold in US dollars, that is generating an unexpected rise in royalty receipts and higher corporate income tax receipts. And we should probably note that coal prices are still falling, now down to a 3-year low and where they were in May 2021. And that is despite a very cold spell in the Northern Hemisphere at present. The US Treasury 10-year yield is still just on 4.76% and up 7 basis points from Friday in the jobs data reaction. A week ago it was 4.59%, so a 16 basis points rise from then. And the price of gold will start today at $2,690 an ounce, up $1 from Saturday and up $50 from a week ago. And oil prices are unchanged from Saturday at just on $76.50 a barrel in the US, while the international Brent price is now just over $79.50 a barrel. The recent rise comes from the fear effect of new sanctions activity. And the Kiwi dollar starts today at just on 55.6 US cents, and unchanged from Saturday, but down 50 basis points for the week. Against the Aussie was still at 90.4 Australian cents. Against the euro also unchanged at 54.3 euro cents. That all means our trade weight index starts today at just under 66.7 and up 10 basis points from Saturday. And the Bitcoin price starts today at $94,909 and up 1.4% from this time Saturday. Volatility over the past 24 hours, though, has been low at plus or minus 0.9%. You can find links to the articles mentioned today in our show notes, and you can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.